Welcome back, my friends. Well, Lyft has a new CEO. And he is promising to bring profitability to Lyft. If you follow this channel, you already know that Lyft is laying off 13% of its workforce. I suppose that we all could have predicted it. After all, Lyft has never been profitable. And investor sentiment has changed. Unprofitable tech companies that have lived off continued financing for years are now forced to become profitable. And for many of those companies, that means layoffs. What does it mean for big tech companies? What does it mean for the economy? And what does it mean for the future of the United States? But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities and include mental health assessment reports, mental health treatment reports, and treatment progress reports. Lyft. Incoming CEO, David Risher, says he is up to the task of driving a better Lyft business, and it starts with taking the fight back to larger rival Uber. Our top priority is getting a great experience to our customers. To a certain extent, a focus on the basics. We pick you up on time, we are priced in line with the other guys and get you where you want to go, Risher said. I am kind of okay with you calling it the battle is back, he added. We are ready to fight, and hopefully do well. The number 2 ride-hailing player said Monday that the Amazon, AMZN, veteran Risher, who has been on Lyft's board for about 18 months, would take over as CEO on April 17th. Risher will replace co-founders Logan Green and John Zimmer, who are taking a step back from active management of Lyft but will stay on the board of directors. Lyft's C-suite shakeup comes as the company's stock price has plunged 76% in the past year amid growing market share loss to Uber. Uber has consolidated its leading position in ride-hailing by continuing to deepen its entry into food delivery, among other super app tendencies. The company's increased market share has weighed on Lyft's results as Uber has reinvested its winnings in lower ride prices and an improved app experience. Investors are hopeful Risher's track record of strong operational execution at Amazon will yield results at Lyft. But Wall Street acknowledges it will take some time for Lyft to regain its footing, if it can at all. We see the transition signaling a strategic shift toward more proactive competition with Uber. That said, the transition could cast additional uncertainty before we get greater visibility on the path forward, Jefferies analyst John Colantuoni said in a client note. Lyft shares tanked 30% after company issued weak Q4 guidance. Here are the key numbers for its fiscal fourth quarter of 2022. Adjusted loss per share was 74 cents. Revenue was $1.18 billion. That is compared to $1.16 billion expected by Wall Street analysts. Lyft said it expects to make roughly $975 million in revenue in the fiscal first quarter of 2023. That is lower than the $1.09 billion Wall Street analysts expected. Lyft also expects to earn between $5 million and $15 million in the first quarter. That's a pretty wide range. It suggests that Lyft's business is becoming less predictable. Lyft reported 20.3 million active riders in Q4. That is effectively flat from the third quarter. That it is up 8.7% year over year. But revenue remains below pre-pandemic levels. In the fourth quarter of 2019, for example, Lyft had 22.9 million active riders in Q4. Revenue of $1.18 billion was up 21% from the $969.9 million posted in the year-ago quarter. So, that is a positive. But while 2022 was an overall increase, revenue seems to have peaked. And that has Wall Street worried. Per SEC guidance issued in December to all public companies, Lyft said it's revising how it calculates financial measures. It will now include insurance reserve adjustments for prior periods. Lyft provided restatements for those results in its supplemental earnings document. Under our updated non-GAAP calculation, Adjusted EBITDA was a negative $248.3 million versus a negative $47.6 million in the fourth quarter of 2021 and a negative $26.7 million in the third quarter of 2022, Lyft said. The company reported a net loss of $588.1 million for the quarter. That is $1.61 a share for the quarter, which is more than twice the loss it posted in the year-ago quarter. It attributed $201.3 million of that to stock-based compensation and related payroll tax expenses. Lyft began its restructuring in November. At that time, it was an effort to reduce operating expenses. Like every other company, Lyft faces macroeconomic challenges. The costs associated with the restructuring efforts don't reflect the performance of Lyft's ongoing operations, however, Lyft said. Across town, Uber reported earnings on Wednesday that beat analyst estimates. Uber posted its strongest quarter ever. Revenue up 49% year-over-year for Uber. It said the number of active drivers on the road hit an all-time high during the quarter. Uber said that it surpassed 2 billion trips in a single quarter for the first time ever. So, Uber seems to be making progress toward the goal of cash flow profitability. 2 months ago, Lyft announced that it is eliminating 13% of its workforce. The layoff was across the board and impacting all teams. "We foresee a probable recession sometime in the next year," said Lyft CEO Logan Green at that time. Also, rideshare insurance costs are rising, Green continued. Shares of Lyft have fell 68% in 2022. The market capitalization of Lyft is now less than $5 billion. Just to review, the market capitalization of a company is the per-share price multiplied by the number of shares outstanding that can be traded on exchanges. You can think of the market capitalization as being the total value of the enterprise, around what it would cost to buy the whole company. Lyft had about 5,000 employees. So, 13% of that would be 650 positions that were cut. "We are not immune to the realities of inflation in a slowing economy," CEO Green said. "We need 2023 to be a period where we can better execute without having to change plans in response to external events," Green noted. "And the tough reality is that today's actions set us up to do that," Green added. The news of layoffs comes in the wake of a reported driver shortage last spring. Layoffs have hit the tech industry hard. Employers are worried about an impending recession. If you follow this channel, you already know that many tech companies have already announced layoffs. Fortunately, everything is not doom and gloom for Lyft. For example, top-line revenues rose for the past year. But given their weak guidance, revenues could have peaked, at least temporarily. Total revenue exceeded pre-pandemic revenue for the first time. It is fair to say that Q3 earnings were weak or weakening in most companies, aside from oil companies. This year, it is clear that Wall Street analysts are valuing profitability over prospective growth. As a result, unprofitable tech companies' shares are getting punished. It seems that the day of reckoning for tech unicorns has arrived. And all companies are forced to either be profitable, find a merge partner, or die. The window for initial public offerings is effectively closed. That is why some Wall Street investment bankers are predicting a wave of tech mergers later this year. If you follow this channel, you already know the economic narrative of the day. Inflation is raging in most parts of the world. Central banks are aggressively raising interest rates in order to tame inflation. Consumers' budgets are getting tighter because of having to spend more on gas and food. So, consumer discretionary spending is weakening. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.